Good evening, ladies and gentlemen. Apologies, I've got neither a rocket launcher, nor am I a CEO, nor really am I an expert in the industry. Before you all walk out, I should say I've done over 40 years in the mining industry. First as a mining engineer, including a stint at Western Deep level, so for 3 glorious months I was the deepest miner in the world. But more recently, in fact most of my career, I've reported on the mining industry. So latterly, for SNL, which is a huge database company, American database company, I've written about trends. So I'm in the English parlance a jack of all trades and a master of none. For those that don't know, 4 years ago there were 3 mining databases in the world. There was the Intiera, Perth-based company. There was Raw Materials Group, that's Magnus Eriksson's group out of Stockholm, and there was Michael Chender's group out of Halifax, Nova Scotia, Metals Economics Group. SNL, a classic American move, they decided to go into mining. They bought Metals Economics Group. Intiera, who I joined, bought RMG, and 2 years ago SNL bought Intiera. September last year, McGraw-Hill snaffled the lot. Now Platts, S&P, and Metals Economics Group and the rest are all part of the same group. Nothing comfortably close. For those of you that are not already depressed, having been at Indaba for the last couple of days, that's the plot of metal prices last year, which you're aware of. I haven't updated these slides since the 22nd of January, but that's the re-ranked plot last year and the year to date. You don't need to be a rocket scientist. The sell-side analysts in here, it's a wonderful job. I did it for a year and realised I didn't understand the markets. They weren't doing what they should have done. But apart from the first bear, this is the last 4 bear markets, apart from the first one that started in April 74, we are plotting the last 3. You look at the metal prices as an index, base metals, this doesn't include precious metals. Base metals are doing exactly what we would have predicted. We've got another year to go, if you take historical precedent. Again, not surprising, metals are following the supply-demand curves. Most investors are out of the commodities at the moment, so it is a straight supply-demand exchange. You can predict supply. Demand you can have a pretty good fix on if you know what the purchasing managers are saying. And that's monitored every 3 months. And China, of course, has been in contraction. It's still growing, but it's in contraction, and it's just been joined by the States. The purchasing managers are saying they're buying less. So this markets are going to carry on down for a while. You can send these slides, I happily send you them and plenty others if you're interested. You hear it here first, gold's just overtaken copper and iron ore as the most important mined metal. It's still less than half of coal, of course. Coal's 300 billion a year. As you see there on that plot, roughly iron ore, gold and copper were more or less equal for the first few years of this millennium. Iron ore went berserk a few years ago. I'll leave it to you to decide if that was the anomaly. But as of about 3 weeks ago, gold overtook copper and iron ore as the most important mined metal. I submit that's some nonsense. Gold is not important in the scheme of things for civilization. I've just unplugged an audio jack. Carrying on. I've got that's fine. This is actually a slide I pinched. This isn't on the SNL database. It's the only slide that isn't on the SNL database. I was at the Roundup conference in Vancouver 3 weeks ago, and this was from the Polish copper producer KGHM. And apologies to the sell-side analysts here. You do not predict the metal price terribly well. This is the red line is the copper price. This is from KGHM, it isn't from SNL. Every 3 months, so every quarter, they pick the median value of analysts from Bloomberg. This is the consensus. So if you look at those squiggly grey lines, that tells you what the analysts were predicting at every point. And suffice to say, if anyone could predict the metal price, they wouldn't be working for a living. Again, we are a cyclical industry. I think the CEOs have done the industry a disservice. They should have realised there was a cycle coming up. You see the Great Recession there, massive depression, much worse than most recessions, but the recovery was massive as well. And the last 4 years we've simply been recovering from an overreaction from the recession. We are, if you look at that trend, not far off the long-term change year on year. The other thing from that graph is you don't need to predict base metal demand year on year, you just need to predict global IP, that's industrial production. I'm not saying that's easy to predict, but if you know what global IP is going to be as a percentage change year on year, you know what metal demand is going to be. This is a survey we do every year, so these numbers are based on all the companies that have an exploration budget of over 100,000. That's 1,800 companies. That's 1,800 companies, and last year they budgeted 8.8 billion. We haven't got the numbers in yet for what they actually spent, it'll be a little short of that. But those are the plots, the green lines are what they're told. We're told every year, we phone all 1,800 companies and ask what they're going to spend. And you see there, the grey little box at the top is what we predict from the companies that won't tell us. And that's usually state-owned companies and private companies. But we've got a pretty good handle on what companies say they're going to spend. Two things to note there. The trend follows the index metal price pretty well, which is no surprise. The other thing is we're still historically high on exploration spend. Now I know it's come down a long way, but if you look historically, and these aren't real numbers for which I apologise, but the inflation's not been huge for the last 20 years. The industry is still spending a lot more than it has historically on exploration. Pretty bad news for Africa. This is the percentage breakdown of budgets, not actual expenditure, but budgets, which more or less follow the actual expenditure. Several things to take away from that. Latin America, percentage increase, massively increasing for the last 9 years. The totals are going down, the nominal expenditure is going down in Latin America, but the percentage is soaring. The main country that's lost out, as you can see there, is Canada. Africa has more or less stayed equal, and that's roughly your geographical share, land area, which means that it's poor, because there's a lot of areas that aren't included in these statistics. For example, we don't get a lot of statistics out of China, Russia and India, so their land areas aren't included. That is a poor number for Africa over the world, as a world share. That's the breakdown. Obviously you can have these slides separately and look at the numbers in detail. One of the things we do at SNL, and this actually is 2 years old, this slide, but the numbers are being updated every quarter. You'll see there African mines are in the pinky colour. This is gold cash costs. African mines dominate the right-hand side of that graph. I'm only just doing the December quarter now, it'll be out in about 2 weeks, but the September quarter, that's funds raised. You see the TSX had a pretty bad quarter, about a quarter of what it raised in the previous area. The thing to note here is the larger companies account for about 94% of the fundraising. The other thing there is the companies that we rank the companies by market cap. Those under 10 million, there are a lot of houses in London worth more than 10 million. Half of the mining industry has a market cap of under 10 million. We plot 3,000 listed companies, and about 1,500 have a market cap of under 10 million. Most of them in Perth and Vancouver. And they haven't got any money either. That's the 1,000 companies that told us their cash holdings at the end of September. You might think that that's not too bad, 12 million average cash holdings. And if you look at the 260 odd that are in Vancouver, they've got an average of 600,000. And of course, averages being what they are, half of the companies in Vancouver, sort of 130, have less than 600,000 in the bank. They've stopped spending. So half of the mining industry not only has a market cap of not a lot, but it has hardly any cash, and nobody's financing it at the moment. That's the drilling in December. We're just about to publish the January drilling numbers. Africa only had 7% of the projects reporting drilling in December. And you can see gold still dominates. That's why I think gold is already priced high enough. Gold is over half of the drilling, it's over half of the financing, it's over half of the deal making. high enough to encourage people into the industry. Penultimate slide, historic precedents. I don't know that you can generally tell too much from history, but if you can, we've got another year of capital expenditure decline to go. That's the current bear market with the previous one. It's plotting it pretty well. It's also, the capital expenditure is exactly following the indexed price down. The sum result of all that is pretty depressing, as you'll all be aware. Market cap down nearly 40% in 8 months. And as I put out a note the other day, there's 880 billion the total mining industry is worth. That is exactly equal to Apple and Google. So the entire listed mining company of over 2,800 companies is equal to the market cap of Apple and Google. I of course don't know if Apple and Google are priced too high or the mining industry is priced too low. It just feels as if something's wrong because I'm biased as a mining engineer. Thanks.